So once again, on behalf of Manitoba Ag Days and MNP, my name is Terry Stakilo. I'd like to welcome you to the afternoon session at the MNP Speaking Hall, and certainly have an action-packed afternoon full of a bunch of information that we think that you'll take back to your operations and hopefully put to good use. Leading off the session this afternoon is Michael Poole. Mike is the regional tax leader with MNP, and Michael is a chartered professional accountant, qualifying as a chartered accountant in 2005. He is a partner and the tax leader for MNP's Southern Manitoba region. Working out of the Brandon office, Michael delivers comprehensive corporate and personal tax services. Mike also provides specialty tax strategies to clients of all sizes and in a wide range of industries, including agriculture, oil and gas. Mike draws on more than 10 years of experience and knowledge to deliver creative, practical solutions to unique business challenges. So with that, I'd like to welcome Mike to the podium.
Thank you, Terry. Good afternoon, everybody. I want to thank everyone for coming out. This is a topic I really enjoy talking about. Farm succession is something that when I'm talking with clients about it, they're often surprised by how flexible and how many options they have. Oftentimes we don't feel like the Income Tax Act is trying to do us any favors. But when it comes to farm succession planning, there are a lot of specific sections in the Income Tax Act that are only for farms and farm families, farm corporations. And so if you don't know about those options, you might think, well, what can I do? Is there anything I can do? And maybe you just give up. So this is something I really enjoy talking about, because not only can we save tax, because anytime I can help somebody save tax, that's a great thing. But the other thing that it often does is gives them peace of mind, because there's often a lot of fear around succession planning, questions that have nothing to do with tax, like how am I going to do this? I've got kids who are farming, kids who are not farming. How do I make it fair? Is that even possible? And so in addition to the tax planning, there's a lot of things that we can do to kind of put your mind at ease so that you've got a plan in place and you can sleep easier at night. So succession planning is something that we could talk all day on. I'm not going to do that because I'd have a bunch of heads nodding in the seats here, but we've got a very short period of time, so I just wanted to touch on sort of the highlights, some of the things that are the most common mistakes that we find that people make, and hopefully by knowing about them, you can save yourself from making those same mistakes. So I'm going to be talking about failing to start the process, the need for a plan, not making use of a farm partnership. You may not have the opportunity to use a farm partnership, and that's okay, but where you can implement a farm partnership into your succession planning, they are very powerful. Not starting soon enough, so leaving it and leaving it and leaving it, which is a common thing, right? Who wants to think about it? We'll pick it up next year. But there are a lot of time-sensitive items in the Income Tax Act. If you want to take advantage of these benefits, you got to give yourself enough time. Not being in the right structure at the right time can cause problems. So structure really does matter. And this is what I talk about when I talk about structure. It's whether I'm a sole proprietor, I'm in a partnership, or a corporate structure. So I'm going to get into that a little bit. And then something I call coffee shop advice, which I say with a grin on my face, because we've all been down to the local coffee shop and you hear horror stories about, oh, you should never do this, or we did this and it was terrible, or it was great. But just getting the right advice for your farm. So you absolutely need a plan, and I put this item first. It really doesn't have very much to do with tax, but it is the most important thing. So one of the most common mistakes we see, that farm families just don't even start the process. And it is a process, and it can take some time. So you need to start the process. The second most common mistake is you start the process, but then you stop. So how many people have done that, where you're at the kitchen table, you get some momentum, you maybe bring accountants and lawyers into the picture, and then it's seeding time, or it's time to get back onto the farm, and you drop it, and then you pick it up 8 months later, and you just keep doing this cycle. Why don't people want to talk about it? Well, it can bring up some uncomfortable discussions. Oftentimes there are farming kids involved. There are non-farming kids in the family. And how are we going to make that work? And so to bring everyone around the table can be sort of a fearful thing, because what if someone gets upset? And that may happen. But let me promise you that you're better to have those discussions now, have those awkward discussions now, than when mom and dad are gone, the kids get the will, and nobody understands why the heck mom and dad did what they did. The other reason that you need a plan is farms have changed. That's not a surprise to anyone in this room. They've gotten bigger, they've gotten more valuable. The land-based value has skyrocketed in the last few years. So it makes it a lot more important to make sure that you're doing this in a tax-efficient way. So planning the way your parents did it in the 60s is not going to work anymore. The landscape has changed. It's a lot more complicated. You're going to need some help. And you're going to need help from a number of different specialists. So you might bring myself in, someone who specializes in farm tax, but you're also going to need to bring your lawyer in. You're also going to need to talk to your financial planner, because if you're talking about retirement and succession, you need to know how much do we need to retire. That's a big question. Maybe we have to bring life insurance into the mix to make the plan work. That's often something that we do to try to equalize between farming and non-farming assets. The idea is use a team approach, get the right specialists in their particular field involved, and everybody's working towards the common goal, which is a successful retirement for mom and dad, but also the success of the farm to continue on for generations to come. So partnerships, and you're going to think that I get $1 from sort of partnership consortium every time I say the word partnership, because I really love working with these, and they're extremely powerful in the context of farm planning. So what is a partnership? How is it different than me just operating on my own? Well, you can have multiple family members in the partnership. That means you can split income. That means you get access to not just one set of personal tax brackets, but multiple brackets each year, so that's beneficial. Helps you keep your tax bill down. Not only that, but you can split the growth. And that's probably the most important thing, and I'll get into that in an example a little bit later. You can split the growth of the farm instead of it all just staying with one person. It's got the same sort of operating risk as being a sole proprietor farming entity. And so you might be wondering, well, why do I want to do this? There's a couple great things about partnerships. The first one, which is not number one on the list, but it's very important, you can eliminate some of the results from cash-based accounting. Cash-based tax reporting, I should say. What happens at the end of the year? Well, if we got too much income, too much taxable income, what do we got to do? Well, we got to buy down, right? We got to get our expenses up to bring our income down, and maybe we're deferring. And those two things, which are common practice as far as a traditional farm tax planning is involved, those two things can create problems for, number one, getting into a partnership, number two, getting into a corporation. And I'll talk about that a little bit later too. You get the same record keeping, so it's not like you're going to have to bring in anything extra than what you're already bringing in to do your taxes. But here's the big one. Being in a family farm partnership, it converts the value of things like inventory, bins, buildings, machinery, all of those other items, it converts them into a family farm partnership interest. Okay, so what does that mean? The difference is inventory, bins, buildings, machinery, when we sell those things, we cannot use our capital gain exemption on them. So if you sell a piece of equipment, you can't use your capital gain exemption on that. Similar with if you sold inventory. But a family farm partnership interest does qualify. So after being in this partnership for 24 months, and that is the minimum, you have to be in that partnership for 24 months, you convert all that value that didn't qualify for the capital gain exemption into value that does qualify for the capital gain exemption. That is huge. And that's the power of being in a family farm partnership. And that's why I like them so much. It can really help with the next step, which is typically incorporation. And the next step from there, which is mom and dad retiring from the farm. It helps us cash flow their retirement needs. It keeps the overall tax bill down. So that's the benefit of a partnership. So I just want to show an example here. So side-by-side comparison. Let's say a farm starts January 1st, 2019. Jim's either going to do it on his own or he's going to go into a partnership with his wife, Jan. And they're starting from scratch, okay? So the value of the farm on day one is zero. We're going to roll 30 years down the road. The farmer's worth $2 million. It doesn't matter whether Jim owns it or it's owned by the partnership, it's still worth $2 million, okay? So what is the fundamental difference? Why has it been beneficial for Jim and Jan to be in this partnership? Okay, so let's look at just Jim, no partnership. Even though that they've been farming together for the last 30 years, from Canada Revenue Agency's perspective, all the value belongs to Jim, and he needs to get taxed on that value. Okay, so so that's a huge concern. And you might think, well, but we've been farming together for all these years, and we've both been active on the farm, and we've both put the same amount of effort in. That's absolutely true, but from Canada Revenue Agency's perspective, it doesn't matter. That $2 million, that belongs to Jim in this example. What are the assets of the farm? Well, if it's in Jim's hands, it's the inventory, bins, and buildings. None of these things are eligible for Jim's capital gain exemption. So a common option for Jim, if he's going to do an auction sale or if he's going to transition, is he might incorporate. So Jim incorporates. Well, he's the only one that can pull money out of that corporation. He put all the value in. He has to be taxed on all the value, all the cash that comes out. So Jan wouldn't be able to extract any of that value because Jim put it all in Canada Revenue Agency's eyes. So at the end of the day, not using the partnership is going to significantly increase Jim and Jan's personal tax on their retirement or succession plan. So let's look at the other option, going into a partnership. CRA looks at this as Jim and Jan earning that value together. So that $2 million each belongs to them, $1 million per person. And what do they own? They don't own bins, buildings, inventory, machinery, and equipment. What they own is an interest in a family farm partnership. And that interest is eligible for their capital gain exemption. So basically what's happened, we've taken $2 million worth of value that only Jim was going to be taxed on, so he was going to have to suffer all that tax using one set of personal brackets, and he couldn't use his capital gain exemption on any of it. Now what do we have? We have a situation where Jim and Jan get to split that value, and they both get to use their capital gain exemption on that value. That's a huge difference. What is a capital gain exemption worth today? Capital gain exemption for farm property is $1 million. Top rate on a capital gain is 25.2%, so it's $252,000 of tax savings. It's huge. Basically, being in that partnership gave Jim and Jan the option, when they went to incorporate, to significantly reduce their tax. So just because you go into a partnership, it doesn't mean that automatically 2 years from that point in time you have to incorporate. Absolutely not. You can be in that partnership for as long as you need to be in that partnership. Generally, when it becomes too taxable, that's when you switch to incorporation, or maybe when there's a succession plan in play, but you don't have to. So really, being in partnership is sort of a first step that you can take on your way to incorporation, and it's going to pay significant dividends when it comes time to do that. So moving on to the next item that most people make mistakes in doing, and it's not giving yourself enough time. The Income Tax Act is full of holding period requirements. What that means is you have to hold it for a certain period of time. We just talked about one. You have to be in a partnership for at least 24 months until it qualifies for your capital gain exemption. So if you come to me and say, okay, it's time to do our succession plan, but we got to knock this out in 6 months, you're not leaving me a lot of room to get some benefit for you. If I say, well, we have to wait at least 2 years. Oh, I don't know if we can wait 2 years. I don't want to wait that long. Or here's the other one. Let's say you've been operating as a proprietor, and I say, okay, well, there's still benefit to going into a partnership, but you got to wait 2 years. You might say, I don't think I can buy my way or defer my way out of tax for 2 more years without getting really crunched. And so maybe you can't get into that partnership. You have to go straight to corporation. So all I'm saying here is you got to leave yourself enough lead time when you start having these discussions about succession and retirement so that you can take advantage of some of the beneficial items that are in the Income Tax Act. There is also a 36-month holding period requirement. This one's a little bit more specific, and it's attached to some mischief, which I think most people enjoy. And I like the fact that somebody thought about this, and it worked well enough that CRA made a special rule to get rid of it. So here was the mischief that this rule comes from. I own farmland, but I don't have a capital gain exemption left because I used it all up. But I know that I can pass my farmland to my kid without tax. So I go to the neighbor who's going to buy my land, and I say, listen, you can buy the land, but you got to buy it from my kid. Okay? So they do that. The kid sells the land, gets the proceeds from the sale, uses their capital gain exemption, doesn't pay tax, and because mom and dad have been such fantastic parents all their lives, they give them a really good Christmas present at the end of the year, right? So that was the mischief, and to me that's really clever thinking, but unfortunately you can't do that anymore. So here's the rule. If you want to give your child farmland or shares or partnership interest, And you want to do that as a gift, that's fine. But if they sell that land or shares or partnership interest within 3 years of you doing the gift, it's no longer a tax-free gift. Mom and dad get dinged with the tax. Okay? So we have to be careful with this. We see this type of planning all the time. Does it have a place? It does have a place. It can be used. You just have to be very careful when you use it. This is the biggest one. Okay? And a lot of folks will think capital gain exemption is king. I got to use my capital gain exemption, $1 million, or if it's husband-wife, $2 million. That is what I got to focus on. It's actually, in my opinion, not true. Because the capital gain exemption is limited at $1 million. And I'm not saying that's a small number. But in comparison to what farms are worth these days, $1 million is not going to cover the average farm these days. So what am I trying to get at here? Well, there's a special provision in the Income Tax Act that lets you gift value to the next generation. It can be land, so you can give your kid land as long as it qualifies. No tax to the parent. You can give your kid shares as long as they qualify. No tax to the parent. So if we think about that in comparison to a capital gain exemption, you might have $5 million worth of farmland. You can give it all away. Versus if you sold it, you only got $1 million or a $2 million capital gain exemption. I touched on this a little bit earlier, cash-based tax reporting. Deferrals and year-end buying can create problems for us. They create barriers to getting into partnership, getting into corporation. We can work around these things, but it's best to get into a partnership structure or a corporate structure before these start accumulating. Because once you're in a partnership structure, you don't have to worry about these. Or once you're in a corporate structure, you don't have to worry about these. Terry, you said I got about 5 minutes left? Yep. Okay, so I'm just going to scoot along here. Splitting value between spouses, we have to be careful here as well. It's important when you're buying land, okay, to do that in joint name. Why is that? I've got a little example for you here, and I'm going to poll the audience. So, at Land Title's office, Jim is the only registered owner of all the farmland. They talked to their lawyer. They said, for probate purposes, you should put Jan on the farmland. So they did that. A few years later, they're going to sell the land. They're going to have a $2 million capital gain. Here's my question. Let's see if we can get some participation. Who thinks Jim and Jan each get to use their capital gain exemption? Show of hands. There's a few. Have you been to my presentation before? The answer is no. Only Jim can use his capital gain exemption. Why? Because Jan became the owner of that land later. If they would have bought it day one together, you could use his exemption, you could use her exemption. In this case, Jim's got about a $250,000 tax liability that he didn't know that he had. Okay, let's talk about structure a little bit. What do these mean? Sole proprietor, partnership. I've talked about a bit of it already. Sole proprietorship is the simplest way to operate. It's going to be the cheapest way to operate, but it's not tax efficient at all. You're really limited to deferreds, pre-buys, and RRSPs at the end of the year. And it's a terrible structure to pay down debt in. Partnerships. From a tax perspective, not a lot better than individually, other than you get to split the income between all the partners, so you can maybe get access to a few more brackets. The big thing here is you're not going to be inhibited by the deferreds or the cash basis of taxation issues I talked about earlier, and in 24 months' time, your capital gain exemption is available to you for use. Relatively inexpensive to use, but still not very tax efficient. Corporations. So, taxed at 9% on the first $500,000, 27% thereafter, so much lower than personal rates. Shareholder pays tax when the money comes out to them personally. The liability is limited to what's in the corporation. So if the corporation gets sued, but all your land is outside personally, that certainly protects that value. This is the most efficient way to pay down debt because you're getting 91 cents of every dollar to pay down the debt, which means you can pay it down faster, less interest. So these are great tools for reducing the debt load. It is a more expensive structure to operate in, so you just have to weigh the pros and the cons. Which structure and when? To me, I always think of sort of a life cycle. So you're probably going to start out as a proprietor or a partnership. You're going to transition to a corporation at some point in time, because if you're successful, which is what your goal is, you want to be successful, you're going to become taxable. And a corporation is the best way to operate. The key is to be in the right structure at the right time. So you're better to be in a partnership structure before you incorporate than to be in a sole proprietorship structure before you incorporate. And just to finish off, get the right information. So what worked for one family in your area might not work for you. What didn't work for another family might be exactly what you need. The tax legislation is complicated. It keeps changing. We've seen that over the last 18 months. It's been quite a whirlwind in tax. The whole idea is get in front of somebody or a group of persons who can have good conversations with you, look at your farm, your situation, and come up with a custom-built plan that's going to work for your family. So just be careful, again, of sort of the coffee shop talk. It's important to get information that is specific to your farm and your family. Good tax advice should pay for itself in the long run. And I always say that not going to that meeting, it might be the most expensive meeting you didn't go to, because if you find out too late what you could have done, we can't go back and fix a lot of this. A lot of times, once the tracks are laid, we can't back it up. So that's why it's important to get on top of it. So I appreciate everyone's time. Thank you for coming out. I think I'm done. Okay, thank you. Terry?
Got some questions.
If any of you have questions for me, I would just encourage you. I'm going to head back to the MNP booth, and I'm happy to answer any and all questions that might be out there. Thank you.
Mike, we actually have a minute for questions. If anybody does have one, we'll take one or two, just in the interest of the group. Some people might have overlapping questions, so you might be able to provide an answer that would be insightful to more than just one person. So any questions in the crowd? Yep, right there.
It's a good question. There's a lot of information on the MNP website. There's been a lot of blogs that have been done over the years. So there's a lot of information there. It will be specific to a various range of topics. So that would be a good place to start. But what I always encourage people to do is take half an hour, get in touch with somebody that you can sit down and have a conversation with, because you're going to get way more value out of that. Because be careful of what's on the internet, right? No matter what you're researching. You might read something and say, I'm fine, and then find out that you're actually not. So I would encourage, meet with somebody, and I'm always happy to do that, but get it specific to your situation. But on our website, there's a lot of good information.
Right, any other questions? Yep, right here.
The passive investment rules.
Can you just repeat the question, Mike, then?
Yep.
Okay.
So I think it's a general question about the passive investment rules for corporations. So basically how they work is passive investment are things like interest and rent, things that aren't active, that you're not actively engaging in. So let's say it's interest. That's an easy one. When your interest exceeds $50,000 in your corporation, you will start to lose your small business limit. So you lose $5 of small business limit for every dollar over $50,000. So at $150,000, your small business limit is gone. So that is the risk of having that passive investment income inside of a corporate structure.
Right. Yes, one more question. Okay, so the question was, if you have land in both names, the first question I'm going to ask you is, how did that land get in both names? Because a lot of the time, because I'll often say, is the land in joint names? And they'll say, yep, absolutely, all the land's in joint names. And I'll say, was it always in joint names? And that's where we get a deviation. If it's purchased in joint name, and we can see that when it was purchased, it was joint name, both exemptions are available. But if a person was added to title later, usually for probate purposes or maybe some estate planning purposes, then you're stuck with the original owner.
So what if you change
Children is different. Okay? So the rule that we're talking about is spousal only. Mm-hmm. Yeah. No problem then. No. As long as the land qualifies when you transition from a parent to a child, as long as the land qualifies, that's a whole other session in itself, that transition can happen without tax, or you can actually trigger tax if you want to.
All right, we're going to have to cut the session short, but anyway, on behalf of Manitoba Ag Days, we'd like to certainly thank you for taking time to join us here at the M&P Speaking Theatre. We understand that there's a lot of different sessions you can go to, so certainly appreciate you taking the time to come here. And on behalf of Manitoba Ag Days as well, we'd like to present Mike with a little token of appreciation, so thanks for coming again.